Hello, everyone. Welcome back and happy Lunar New Year. Thank you for joining our webinar today. My name is Mikey, and I'll be your host and moderator for today's session. As we wait for more people to join, tell us why you're here today and how you feel as an emoji in the chat box on your right. That's nice. Yes, please tell us how the recent public holiday was for you and if you celebrated Chinese New Year as well. Yeah, it was a very long holiday. For those not in Malaysia, we actually had a public holiday that extended from, it was Saturday, Sunday, Monday, and Tuesday. Hi, Andrea. Lots of fun. I'm sure lots of you went back to your hometowns as well, to see your families, collected lots of ang pao. Hello. Right, and we can make a start. So today I'm very honored to be joined by Michelle Chin, founder and host of Duit, to present Making Money Moves, Financial Management and Budgeting for the Year. This is Michelle. But just before we start, I just want to go through some housekeeping slides. So throughout the presentation, I want all of you to ask your questions, participate in polls, and share your thoughts. To do so, you can just type your message in the chat box to your right. If you want to address your questions direct to Michelle, you have to write @Michelle Chin, and an option will come up as well if you want to keep it anonymous. Also, just a reminder that this presentation will be available at the end of the session as a handout on the right on your screen. You can see on the top right, it says handouts. So this session will be interactive. It'll be filled with lots of chat-in opportunities, polls. So please, 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 I encourage all of you to participate as much as possible. And you can even talk amongst each other as well. Share. Okay. So without further ado, let's welcome our speaker, Michelle. Michelle is the founder of Duit, a woman-focused personal finance platform aimed at sharing everything money-related, from spending, saving, managing debt to investing, as well as making more money. She aims to break down taboos and normalize money conversations, especially amongst women. She has run similar personal finance talks or workshops with Astro Malaysia, Segi College, FI Life, DHL, IBM, and many more. Michelle is also the co-founder and COO of Oyen Pet Insurance, a digital-first pet health insurance platform in Malaysia. Right. Over to you, Michelle.
Thank you so much. Good morning, everyone. So nice to see all of you here this morning, learning about money, all things money. What a fantastic way to start the rabbit year for those who are celebrating Lunar New Year. So just a quick one from me today. I want to get through like the slides and the information as quickly as possible, but without losing the essence. But we want to get through to your questions. So I want you to take the opportunity to ask as many questions as you want. Feel free to PM me privately if you have any questions that you'd like me to know, but then not share your identity to everyone else. I'll be happy to tackle those questions as well. So before we start, just a quick disclaimer. Everything that I'm sharing here today is based on my experience and my own knowledge. So I'm not a certified financial planner, so don't take my words and do what I do, and then if anything happens to your money, I can't be liable for that. So just a quick one: always do your own research before you make any decisions with your money. Right. So I have split this session into 3 parts today. The first one is my favorite. It's about the psychology of money, and I always think that when you start with understanding the psychology behind why you think about money a certain way, it'll help set you up for understanding anything related to personal finance better later. After that, we'll get into some important personal finance concepts that I think are very important and I use every single day. And then finally, a bit about how you can chart your path towards financial independence or financial freedom for yourself, which I believe is something all of you are looking forward to. So, the psychology of money. I have a question next, and I want you to think about it, which is, when you were growing up as a kid, I'm sure that's when you were first introduced to the concept of money. Maybe, your parents told you some things about money, or you experienced something that is related to money growing up. Was that memory of money a positive one or a negative memory? Right? You can tell me your answer. You can share a story if you want in the chat as well. I would love to hear from you. But for me, I don't think it was particularly negative. But I do remember my parents saying things like, oh, like we need to be more frugal. Like you can't spend money that way. So maybe there was some negative connotations about how money was a scarce resource, right? So the thing about money is that it is influenced by things that we were brought up with, and it's influenced by things that are around us since we were born and since we were young and began to understand things. So, for example, family values, how your family taught you about money is one of the influences of how you think about money when you grow up. The media, of course, when you see like news, headlines, anything on social media, all these things also influence how you think about money, and obviously culture as well. I think probably majority of us are from like an Asian culture, so how we perceive money and how we understand money is different from other cultures. But what I've learned, if you see like the bottom right corner, is that actually your own experience and your own thinking of money probably makes up only like 0.000 many zeros 1% of what is happening in the world, but it's what we think the world thinks about money, right? I'm going to repeat that again. Our own experience about money, with it's actually only a very very small percentage of how money functions in the world, but we think it's the world. So what's different, right? Like why do we think that way, and what is the real reason behind the real essence of money? And next thing I want you to think about right now, as you've grown up from a kid, think about the first word that comes into your mind. Money is something, right? Money is, for some people, a root of evil, right? Or money is a source of happiness. So it can be positive, it can be negative, right? So the number that the name or the sentence that you thought about, was it positive or was it negative? Right? Tell me about it, or you can think about it. Yeah, okay. So you can answer the poll here. Like when you thought about money is dot 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 dot. Was it more a positive thought or was it a negative thought? Right. Ooh, okay. Love that. That's more positive than negative. Fantastic, fantastic. I think money can be a nice source of happiness if you know how to use it right. Perfect. Very, very nice. Thank you for answering the poll. So, if we do think about money negatively, or I mean positively as well, actually, money is not like the source of a problem or source of an emotion, right? Money is just a tool, and it's how we use it, how we think about it, how we talk about it, and how we act around money that causes us to think about money differently, whether it's positive or negative, right? And I just wanted to share a quick example of how thinking about money in a certain way can impact how we behave around money and how we perceive money, going into like our lives and like charting our path towards financial freedom. For example, if you ever thought that, I rather be poor than rich, because rich people are not nice, they're arrogant, or they're evil perhaps, or I'm frustrated with the system, right? The system. Money's not that important, doesn't bring me happiness. Don't really like rich people, they're not so good, same as the one at the top. Money causes a lot of problems, right? Or like, you have money to invest, like who has money to invest, right? And there's no point saving money, at the end of the day we won't have enough money to live our lives. These are all negative money scripts, and if we continue to think about money from a negative standpoint, we'll always be in the headspace, in a negative headspace, right? And we'll whatever that we do with money we wouldn't be reaching our fullest potential with it. And that's why I think it's really important for us to think about money from like a positive way, from a positive perspective, and we can use it. It's just a tool, and we can use this tool with our positive outlook and positive perspective in order to create the future that we want to create, whether it's for yourself, for people around you, or for your family, right? So just the last one on like why money is such a polarizing topic, and it's because many of the biggest life decisions in our lives are related to money, whether or not we think that money is important or not. For example, buying a house. Do you buy? Do you rent? That's always a polarizing topic. Going to university. Do you have to go to university? Do you have to go to an expensive university? Do you have to be um, do you have to have lots of student loans when you graduate in order to have like a good career? Choosing a job, it's also polarizing and it's highly related to money. You do a job that you love but pay you less. You also compare like your jobs to your friends. Finally, family, like having a family, whether it's your own family or like caring for the family around you, also highly related to money. So it's important to start thinking about it from a more positive standpoint, and that's why I think like the whole psychology behind money is really important, and that will help frame us the right way to start understanding the next parts of this session today, which is around like the concepts of personal finance as well as how you can create financial independence for yourself. So if you have any other questions, feel free to pop them in the chat and I'll be happy to tackle them after this. So, key concepts in personal finance. The first question I'll ask you is, what do you do after you get your paycheck for the month? I think it's around payday now. Like some people who have gotten your paycheck for the month, some of you soon. So, what do you do right after getting your paycheck? Very nice. I see lots of good answers in the chat. Are you sure the answer's not like treat yourself? Perfect. Okay, so I have this chart here. You don't have to take a screenshot because you get a copy of this, but this is my own way of looking at what do I do with my paycheck after I get it. So this is after looking at like many different components of what probably is a wise way to spend your paycheck. The first thing to do is looking at that. That is a very long topic, but the most important thing to remember is that never have high interest debt, and that, for example, includes credit card debt. Don't owe money on your credit card. Don't just settle the minimum amount. Always clear off the entire bill, right? Because the interest on your credit cards are insane. So if you have any high interest debt, clear it out first. So that's what I would do first. If I have any credit card debts, if I have credit card bills, I will also pay that first as soon as I get my paycheck, right? So if you don't have high interest debt, right, like if you go down, do you have emergency funds? And we'll talk a bit about that later if you don't know what it means. But let's say if you don't have your emergency funds fully funded, then you probably want to build your emergency funds when you get your paycheck, right? So first important thing is that. Second important thing is emergency funds. You want to build that to at least 3 months, but first before you start looking at other things like saving for something else or investing it. Third thing is large purchases. So you go up from the emergency funds. So if you have your emergency funds fully funded, the next thing to think about is something called sinking fund, and I'll cover that a bit more later, what that means, and I'll also cover the question on where should we save our emergency funds. I'll share where I save my own emergency funds as well. So this saving for something that you're anticipating, like you are thinking about buying a house, or like you're thinking about even like buying something that's expensive, like the next phone, right? The next iPhone in 3 years time. So that is something that you're saving towards, and that's called a sinking fund. So you can save for that. If you have nothing, at all you're saving for, or like you have no debt, then you can look at investing. But as you see, I have a little note down there that says if I'm already in the zone of like having a sinking fund, I'll already start investing. So that's how I split my paycheck: debt, emergency funds, sinking fund, and then investing, right? Usually people split a portion to saving for their saving fund and then also investing. So always think about this when payday comes along, like before you think about like treating yourself or others, like do all these things first. Medical insurance is actually part of your fixed expenses, and then we will cover that shortly. Perfect. So after getting a paycheck, maybe some of you are getting a pay raise this year or a bonus. What do you do when you get a raise, or what do you do when you get your bonus? In the past, I used to have something big that I want to buy. So I always wait until my bonus time or my raise, and I'll buy something that's nice for myself. So that's how I usually treat my own bonus. Yeah. Treat yourself. Yes, yes. After a hard year at work, usually I treat myself. Perfect. Thank you for sharing. So, one thing about raises and bonuses, I think there's no problem at all treating yourself. As it would be great if you can kind of split that into like treating yourself and also saving or investing. I usually try to invest at least 50% of my own like bonuses in the past. So that's something that I would recommend. And I really like what Nadia said about living below your means and investing more. And when it comes to pay raises and bonuses, what I think it's important to always remember is something called lifestyle inflation. Lifestyle inflation is exactly what you see on the screen. When you were making 5,000 ringgit a month, maybe you got like a simple car, you cook at home more often, you don't really eat out, you bring lunch to work, and then you only shop when needed and you only shop discounts, right? Because then you're saving money and then maybe you feel like you're not making enough. But then maybe you get a raise like a couple years later and then or you change your job and you now make 8,000 ringgit a month. Then you start upgrading your lifestyle. You get a nicer car. You go for like more takeouts now because you know it's convenient. And you don't want to cook, you don't want to clean, and then you buy things more often. You treat yourself more. If you continue this pathway down, and even if you double your income in like a couple of years or even decade, you continue to upgrade, get nicer car, nicer house, nicer food, more eating out, like going shopping more often. It doesn't mean that it's wrong to improve your quality of life, but you should never increase your spending or increase your expenses proportionately to how much you're making. Because if you do that, you'll always be only saving and investing, um, a small amount. But imagine if you inflate only a bit of your lifestyle expenses as your income grows more, then you will be able to save and invest more. And what that means for you in the long term is that you can reach financial independence or you can get into retirement earlier and you can do anything you want with the extra time that you have, right? Then it no longer means that you're financially independent at age 60, and you can maybe hit that at age 50 where you have more time and more energy to spend the money the way that you want instead of spending it earlier in your life, right? So this is about lifestyle inflation. There's this thing, I can't remember the name of what it's called, but it says that if you inflate your lifestyle, let's say today, okay, you start making a bit more money and then you buy a new hat, right? What it brings to next is that after you have your new hat, then you look at what you have on your body, your clothes. Like now you have to upgrade your clothes as well to in order to fit the new hat that is more, that's nicer than the rest of the ensemble on your body. And then, oh no, like you have to change your shoes, you have to change your bag. So it's a never ending cycle if you continue to think about it that way. So avoid lifestyle inflation. Living below your means, definitely. I think with increase of money, you can easily afford what you want to, but it doesn't mean that you should inflate what you should spend. So always remember this, especially to those who just got your raises, your bonuses. You can inflate it a little bit, but not proportionally to how much more you're making, right? If you have any questions here, feel free to ask me. Okay, great. So those are just some reminders that I think are always super, super important to remember, right? Like before you look into other parts of personal finance. But now we're going to go into some personal finance components that I think is important. I'll cover three main items today. One's about spending, one's about saving, and one's about investing. I'll go through spending quickly because I think a lot of us already know, already spend well and you know how to track your money. but we'll go into more saving and investing because I see a lot of questions about that. Great. So my first question is, you don't have to tell me if you don't want to, or you can PM me privately. How much did you spend last week? Do you know? And what was your highest expense from last week? Maybe it's not such a great question this time of the year because it was just Chinese New Year. Maybe a lot of us spent a lot of money with our family, like on food, on like ang paos. So, but you can think about that. Flight tickets, yes, to visit, to go home for the holidays. So why I think it's important is less so about what that amount is, less so about what that expense is. It's more about the awareness of what you spent and how much you spent. The reason why, like the word budgeting or like the word spending plan, I like to use the word spending plan more because budgeting feels very like scarce. Like I'm trying to like budget my life. I like the word spending plan because I'm planning how I spend my money. It equates to stability. And what that means for you is that if you know how you're spending your money, you know where your money is going, you can plan, you know how much you're saving, you know how much you're investing, you know where you're going towards with your financial journey. I think that's very important. It sounds simple. It sounds like the world's most simple thing. It's so simple that most of us don't even do it, right? Maybe you stop tracking how much you spend a few years ago, right? Because it's just too much hassle. But I can tell you that it is actually one of the most foundational pillars of personal finance that will help set you up for success for your saving and investing later on. So if you maybe you are not already tracking, you don't know much about tracking, I'll give you two tips to get started on tracking or thinking about like creating a spending plan. The 50-30-20 rule is one of the most popular spending plans in the world. It's a very, very simplistic way of looking at things because it doesn't take into consideration things like, when you start making a lot of money, you probably don't have to spend 50% on needs, right? But if you are in early stages of your career, the first 5 years of your career, or you don't really know where to start, I think this is a great place. So 50-30-20 makes up to 100%. What it means is that you split your entire salary, obviously minus EPF and tax deductions, into this percentage. Half goes into needs, and what that means is rent, bills, food, insurance, transportation, and also clearing your debt. Because all these things are your fixed expenses and they're important, right? So 50% to that. 30% goes into other ancillary things. For example, eating out, entertainment, self-care shopping, all these other things that are not a fixed need, right? And then 20% can go into your savings and investments. So that's like the simplest way. If you have no idea where to get started, I think this is a good like rule of thumb. But as you become more advanced with your personal finance journey, then you can adjust that according to how much like you want to increase certain other percentages. This is already minus EPF and taxes. So your 100% is like what is left after the deductions that your company or you have made for yourself for like EPF and all. So this would be separate savings for other things that are not EPF, as well as like your own other retirement investment. I wouldn't recommend only depending on EPF for retirement savings, but we can talk a bit more about that later. So this is getting started. Maybe you want to think about growth, right? Like how do I bring my spending like one level above or like become better? This is how I look at like a growth mindset for like spending plan. One is looking at my historical expenses. So if you've been tracking your expenses already, what you should do is look at what you've been spending on, and then create categories for your spending. Everyone's category is different. For example, if you are not someone who cares a lot about like skincare and makeup, then you don't have to have a category for that. Insurance is a fixed expense. So if you see 1, 2, 3, 4 on the needs, it's under fixed expense for needs. So first, going back into growth and spending plan, I will look at historically like what I'm spending on, categorize them into different categories based on your own needs, your own personality. Then number 2 is identifying your spending principles, right? For example, if what I believe in is that if you truly love doing something and something brings you a lot of joy, like spend on it, I will go for it. It's called guilt-free spending. For example, I love food. I will have like I will allow myself to spend on food, but if I don't like something in particular, like I don't buy clothes, then I don't really have a budget for clothes because it doesn't bring me joy, right? So why would I want to spend more money on something that doesn't bring me joy? Instead of spending on that, I move all the money that I would spend on, random clothes or random trinkets up into spending on food because that brings me a lot of happiness. So identify your spending principles and set up a realistic spending plan based on your spending principles. Realistic can mean a lot of things. What you can start with is understanding your categories of spending. And then from there, like historically, what you've spent, what you are working towards as a target, and then slowly work your way towards the target. And that's why it's important to look at historical because you may think that you're only spending 500 ringgit on food a month, but after looking at your historical spending, it may look like you're spending 1,000 ringgit on food a month, which is 2 times more than your target. So you should look at this historical, set up a target and move towards it instead of like hurrying yourself towards that target. Finally, I think like what I mentioned just now, guilt-free spending, I think that's important. Don't deprive yourself because you're working towards financial independence or else you just be miserable in your journey. I think the journey is as important as the goal. So you have to enjoy the journey and let it motivate you towards reaching your financial goals like later in life. And always add a buffer in your spending plan. So I always have a 10% buffer because there are always things that come up, right? This month, maybe, something happened to your tire. Like next month, like suddenly it's your mom's birthday and you have to pay for an expensive meal. And suddenly it's your best friend's birthday or like your best friend's wedding. There's always something that comes up. And they don't necessarily fit in your categories of spending typically. So you should always plan for a buffer, be it like 10% or 15%. That's what I usually do. And always continue to track and you can continue to adjust as you go. So that's what I would recommend for like a more advanced way of looking at a spending plan. Great. This is a popular topic, saving. So how about saving money? Where do you save your money currently? What do you use? And how much do you save monthly? Right? So a lot of questions about emergency funds and sinking funds earlier. So I'll explain what it is. Emergency funds are like a set of money, usually between, you save expenses for about 6 to 12 months. It's for situations where it's an emergency and you can't make any money and you have to depend on this fund in order to pay for your fixed expenses in your lives. And it's for emergencies only. So you don't touch this money unless it's for an emergency. So 6 to 12 months, you in the past it was a 6 months rule of thumb, but I think as we've all gone through COVID and a lot of people losing their jobs for a really, really long time, it seems fairer to have something like a 12 months emergency fund currently. So I think that's one of the most important things you need to save up for, and you have to put it in a place where you can access when you need to, but not access so easily that you're using it to buy like the latest iPhone, for example. Right? And also consider your job stability when you're building your emergency funds. Let's say you are an entrepreneur or you're a sole proprietor type entrepreneur, and then you like your job is it goes up and down. So some months you make a lot of money and some months you don't make any money at all. When you have a lot of fluctuations in your job stability, it's important to have more emergency funds because there may be more chances of you needing that money to survive on when you have no projects, when something happens. So that's emergency funds. Next one is called sinking funds. This is less commonly known than emergency funds. What sinking funds are is essentially it's saving up a pool of money for large future purchase. For example, you know that you want to buy a house and you have to save up for your house deposit, right? So let's say like 20,000 ringgit or something. That's something that you're working towards. What you should do is you should set a goal and you know how much you're saving. Towards, and then you split that up into like something manageable from a monthly basis. It doesn't necessarily have to be a huge thing like a house deposit. It can also be, like I mentioned just now, a phone, like every 3 to 4 years you maybe have to change your phone, right? It may be the time that it's gonna not work anymore. So you can start saving up for your phone, so that when you reach this juncture when you need to use the money, you don't have to scramble and be in a deficit that month, or like use your credit card and not know how to clear it, or like only eat instant noodles and bread for the month because you're already saving towards it, right? And it doesn't even need to be something that is super not as important as a phone. It can be a holiday. That next year you want to travel to Japan, and roughly it will cost you X amount for flights, X amount for accommodation, X amount for spending. Instead of wondering like how you're gonna get the money to to go to Japan, you can save something up, right? Sinking fund, create sinking fund, and then save towards it. And how you can save towards it is this. Sounds simple, but this is the key to being able to save up for what you need. One is set a goal, right? Like what are you saving towards? How much does it cost? So, for example, your savings, your emergency funds may be like 15,000 ringgit, for example. So, how much is the total cost? The third one is how much you have to save periodically. So, let's say, making it easy, okay, 12,000 ringgit. You want to save 12,000 ringgit in 12 months. If you split that into 12, you have to save 1,000 ringgit a month, right? Does that sound reasonable? And that's why it's important to split it up, because you may think that, okay, I want to save 10,000 ringgit in like 6 months, but if you divide it up, it doesn't seem like it's possible at all. So it's important to split it up, think about whether it's realistic, and then adjust it again based on like either bring down the cost or increase the number of months that you have to save towards it in order to achieve your goals, right? The fourth one is pay yourself first, like I mentioned just now. Like don't treat yourself first, pay yourself first before you treat yourself. And then finally, save at the right place. And I think that is where everyone's most interested to learn about. And I'm going into that next. Where do you save your money in order to, like what Irene said, make the most out of it? So, like I mentioned on the left, how you calculate the amounts, I think you know that already. How do you identify if it's the right place? Usually, there are three places where people save their money currently. One is their savings account. Hopefully, no one is saving money in their current account, because there's nothing there. Like your money only depletes in value with time. So maybe you're putting your money in savings account currently, or maybe you're using fixed deposits at the bank, right? And that, I don't know how much that now. Maybe that's like 2%. I'm not sure. The downside is, them giving you a very long lock-in period, so that's not great. ASB is good too if you have the opportunity to use it. Not all of us have access to ASB. And then there is money market funds, and that is something that is more popular nowadays, and you will hear about it, and I'll tell you more about that. But personally, I put all my emergency funds and my sinking funds in money market funds. It's not something that I would recommend for everyone to do, because it is not guaranteed, and the rates can go up and down. But there's a lot of flexibility. Money market funds is something that is very similar to a fixed deposit. It's similar to a fixed deposit. The reason why your bank doesn't offer it to you is because they don't make money from it, like fixed deposits. Money market funds don't have a lock-in period, and they have a highest interest rate. The concept behind how it works is the same as a fixed deposit from a technical perspective. To you, to us as a consumer, is similar, just that it doesn't have the same guarantees as a fixed deposit. So it's something that you may want to think about when you are considering where you're saving money. But personally, I don't think it's a problem for me. Hence, all my money is in money market funds. What you want to think about as well is the liquidity of it. So assuming that you need that money very soon, like very immediately, you may want to put it in somewhere that's more easily accessible. Yes, correct. I'm referring to PIDM, when I'm saying guaranteed. So fixed deposits are PIDM covered, but then money market funds are not. So that's something to think about. And money market funds are usually not Sharia compliant. So that may be something you want to think about as well when you're saving your money. But I think there are more and more options that are nowadays, so it's something that you can consider. So this is what I would recommend. I'll just quickly go through some of your questions first. Yes, touch and go is safe, no problem. Saving in gold, no, don't. So I would not recommend saving your money in an investment type vehicle. When you're saving money, you're not investing, right? You're saving with the idea of preserving the value, right? Saving is on preservation, so you shouldn't put it in a place that fluctuates greatly, because let's say today I'm saving my emergency funds and I know I'm saving like few like 15,000 ringgit. When I want to use it, I want to have at least 15,000 ringgit. But let's say if I buy gold or I buy crypto with my savings, it may be 5,000 when I use it, because you're investing. That's a form of investment, and it's not a form of saving. So don't put your money where it fluctuates greatly. You're not saving, you're not investing with it. Like if it's something that you're building up towards, whether it's an emergency fund or sinking fund, save it in a place that's quite guaranteed. Don't invest the money that you're saving, right? So don't put your emergency funds into any investments. That's what I would say. Chance of losing money market fund, not that I've heard of. So that's why all my money is in there. um, Crypto's not necessarily gambling, but we can talk about that shortly. So I'll just quickly see if there's anything else. Yeah, I think all the questions on saving is covered. So if you have any other questions, feel free to ask me. Yes, I will share a sample later. I'll show you where I save my money market funds and where I save my emergency funds as well. I'll share all the platforms I use before we end the session. So finally, I will talk about investment, because that's something that all of us are very interested to learn about. What does retirement mean to you? What does the idea of retirement look like in your head? Do you foresee yourself like looking old and sitting on a rocking chair? Like, is that what retirement is? Or retirement looks like something that's completely different, right? So financial independence, there's actually a way to calculate when you can reach financial independence. If you roughly know how much you're spending monthly, you know how much you want to when you want to retire. If you multiply that, you'll be able to know how much you need at financial independence. Or you can reverse it and identify like how much you want, how much you can save, and then when you can retire, right? There's actually a calculator, and I will later post it. Maybe Mikey, you can help me like post that link into the chat so that you guys can check it out yourself at your own free time. Like figure out, like get your amount in your salary, your annual expenses, your investment, and the returns for your investment, and you can roughly calculate when you're gonna reach financial independence. So I can recommend that. You can also use the EPF calculator. Yeah, but I think this is a bit more sophisticated than the EPF calculator, so you can use both and decide which one is more suitable for you. So the final part of today's session is about financial independence and how do you invest in order to reach financial independence. I think that's the question, the $1,000,000 question in all our heads. Do you want to be a millionaire? Yes? No? No need to be a millionaire? You can answer the poll. Let me know what you think. Do you want to be a millionaire or not? And maybe today, after you learn some tips from me, I can share how you can hit closer towards becoming a millionaire. Or why do you guys not want to be a millionaire? Great. So the first thing I want to talk about before we go into like investing. Yes, exactly. You actually have to be a millionaire in order to retire, especially in Malaysia. But the key thing that I want you to remember here is time in the market is better than timing in the market. What that means is that the earlier you invest, the better than trying to figure out when should you invest to in order to maximize your profits, for example, or your investment returns. I have a quick one here. I think you already know the answer, but let's say you have two people here. There's Ida and then there's Brenda. Brenda starts investing when she's 35. She invests 2 times more than Brenda at 1,000 ringgit a month. We're assuming that both investment returns are the same at 8% a year. And for Brenda, she's 25, but she starts saving and investing a lot of money, 500 ringgit, which is half of Ida's, when she's at 25 already, assuming it's the same returns. Who will have more money at 65? You know, I already said that timing is time in the market is better than timing the market. So as you guys already can predict, Brenda actually will have more money than Ida in the long term. And that's why if you see above there, invest young, invest consistently, it's more important to start early than it's important to have a certain amount of money to begin. And that's the power of compound interest. Yeah, start saving the minute you start working. That's a good one, Angeline. Or start before you're working. If you're already making an allowance from your parents, you're already getting your ang paos as a child. Try to start looking at how you can invest that money or ask around in order to get that, right? It's actually not hard to get 8%, but I can share more about that later. So, are you ready to invest? Before you invest, there are a few things to remember. One is I wouldn't recommend investing if you have not cleared up your credit card debt. I know this can be polarizing, but that's my personal opinion. Next is emergency funds. You should have emergency funds before you invest. And you want to roughly know your risk tolerance and your investment goals, right? These are just some basic information about investing. And don't worry, these slides will all be shared with you after, so you can go home and revise if you want to look at it. But we always talk about like high risk, high return, like low risk, low return. And it doesn't necessarily mean that I am afraid of risk and hence like I should only invest in something that's very low risk, for example, cash. And I'll explain that a little bit later after this. The other thing that we want to be reminded of is investing type. So when you think about investing, there's something called active investing and there's something called passive investing. Active investing means that you're more hands-on, you're always checking the stock market, you're always checking the prices, and you need to do a lot of research and analysis, and your goal is to beat the market, right? Like actively, like when you think about buying stocks, you're probably thinking about a person who's looking at charts and like, okay, today I'm gonna buy this, tomorrow I'm gonna sell that. So that's actually called active investing. There's more flexibility there. There's potential for high returns, but it's very expensive. You can potentially lose a lot of money, and it's a lot of time. And I don't do that. Instead, I do something called passive investing. It mirrors the return of the market. There's not so much buying and selling going on. It's more just buy and hold, buy and hold, buy and hold until you retire. The pros are obviously not so expensive because you're not doing a lot of transactions all the time. It's quite transparent. It's rather low risk, but obviously flexibility is low and the returns are average. But when I say average, it can be around 8 to 10%, which is probably something that you guys are looking forward to. So some examples of active investing and passive investing, and I'll explain a little bit later. Active investing means you're buying and selling maybe like stocks. Property rental is also an active form of investment because you need to actively manage it. You have to get tenants when your tenant leaves, to manage the property, you have to talk to an agent. Unit trust is not active on your side, but active from a unit trust consultant side. Passive investing is something like ETFs, exchange traded funds. We don't have a lot of time to go into the education of exchange traded funds today, but you can try to Google it or you can ask ChatGPT to explain it to you easily what ETF means. But that's a form of passive investing. Bonds as well is a form of passive investment. And so these are just some examples of what they are. And so how do you choose the right investment for yourself? First, you need to identify what are your investment goals, right? How much do you need when you retire? And then identify some form of risk tolerance. And I'll explain to you my way of looking at risk tolerance. Not so much of like, oh no, like I'm scared, like, crypto is gambling, so I shouldn't look at it. It's like high risk, no returns, right? So I'll talk a bit about that. Last one is on time horizon. How long do you have to invest before you reap the rewards of your investment? So, for example, first is style, right? Like passive or active investing. How much time do you want to spend? Less time, more time? So that determines whether you should invest in actively or passively. Are you interested to learn? Are you eager to like do a lot of like reading and research and analysis in order to invest? Or do you want to be more passive? So that will determine your style of investing. Budget. How much money do you have to invest every month? Do you have your emergency funds already sorted? And then finally, how do we look at risk tolerance? To me, if I can sleep soundly at night when my investments go up and down. That's how I know I can take this risk, right? If an investment keeps you up at night and you can't sleep knowing that it is fluctuating, then it is not an investment that's suitable for you. For example, you buy Bitcoin because you hear that it's good, but when Bitcoin prices go up and down, you're like, oh no, like what do I do? Like I cannot sleep. Like what if all my money goes to zero? Then that's not a suitable investment for you, right? So that's how I look at risk tolerance. So finally, I think I saw someone saying, talking about robo advisors. So robo advisors, I would call passive investment because they invest in ETFs. So robo advisors fall under ETFs. You can buy them through platforms like Stashaway, where you have less control, but you don't have to worry because all you need to do is put your money inside. Or you can buy ETFs from platforms like Tiger Brokers, or actually in Malaysia now you can buy them on Rakuten Trade. For stocks, you have to buy them on a platform called a brokerage, and brokerages, for example, are like eToro, Rakuten Trade, or FSM1. And for those that are a bit more traditional, crypto is a type of investment. The platform that you have to buy cryptos on is called Digital Asset Exchange, and some examples of that is Luno. And I think this is important because when you say I want to buy Bitcoin, you can't go to the bank and buy Bitcoin, right? You can't go to Maybank to you and like buy a Bitcoin there. You have to use a platform, and you have to use a licensed platform. So these are some things to remember. Yes, cryptocurrencies platforms, make sure when you use platforms or companies, they are approved by the Securities Commission, right? Do your own research. Like don't end up in a situation where you cannot recoup your money back. So a quick ending to this is investing rule of thumb. So if you have a lot of time, right? Remember I talked about time horizon. If you have a lot of time, you have more than 10 years, you can look at buying equities because it will eventually even out the returns with time. If you're looking at something more medium term that you're saving towards, then I would say buy something like bonds. If you need something money really, really quickly, like emergency funds or your sinking funds, I'll put it in a cash type investment or cash type place to save your money, which is like money market funds or fixed deposits, right? I actually have some examples at the back here, but I won't go through them today. You can take them home and read through them yourself. So I have three personas. If you're a millennial, you know how you should invest, right? That's based on my own experience. So don't take it and run away with it and then blame me later. If you're Gen Y, these are some examples of how you can invest for like your near-term goal, your medium-term goal, and your long-term goals. And then if you're a baby boomer and you're making a lot of money, and you want to retire soon, you want to buy Chanel bag, for example, here are some examples of how you can save and invest towards reaching your goals, and buying different things at different ages. Great. Before we end, there's always things to remember, which is one, always diversify your investment. Don't just buy one thing and one thing only. Two is consider fees. Fees can eat up a lot of your investment returns. So don't just invest without looking at how much it will cost you. And finally, estate planning is important. So think about, if you are not around anymore, like who does the money go to? That's also important. So, um, what about myself? I think this is something everyone wants to know. For my travels, for my emergency funds, and my sinking funds, I put it into something called a money market fund, but I use Kenanga Digital Investing. They have something called, I forgot what it's called, but they have a form of money market fund. So I have money in there, and I also have money in Stashaway. So both money market funds is where I put my sinking funds and emergency funds. Speculatively, I do have cryptocurrency because I bought them a long time ago. So all my cryptocurrency are in an SC approved platform called Luno. For my retirement funds, aside from EPF and private retirement schemes, which I have both of, I buy my stocks on interactive brokers in the past. Now I buy them through Rakuten Trade, for my US and Malaysian stocks. And then I also do monthly deductions from my bank account into Stashaway. So that's how I manage my money, from savings and investing. So that's about it, from me. Sorry, I'm very short time for Q&A, but these slides will be shared, don't worry. And I will invite Maggie back to do a Q&A.
everyone. Just before we get to the Q&A, you're already asking for the slide, so I'll be sharing that as a handout. You can download it on the tab on the right. There you go.
You can download the slides here. Don't worry.
Yeah. Okay. So thank you very much, Michelle. That was a fantastic session, and thank you for everyone for engaging. Love seeing your comments coming through. I know that Michelle has already addressed several of your questions during the session, but we do have some that came in during the registration process that we'd like to address first. So we'll be focusing on that first. But if we don't get to your questions, please don't worry. You can always reach out to your coach in the Naluri app. So let's get to the first question. I've just started my break. I have an emergency savings, which I already set aside for this break, but I hate using that stash and seeing my balance slowly reducing day by day. How do I reset my mind as it is to make me feel less anxious?
Oh, okay. So that's all about like the psychology of money,
Mm.
right? I think at the end of the day, you have to identify the purpose of what you've been saving up for. And each item has its own purpose. Your emergency fund's purpose is for emergency situations or situations where you are not making money and you need, somewhere to draw that money from in order to spend it. And you have your investments, which is for your retirement. So you shouldn't feel guilty about using that money because you're using it for the purpose it's intended for. If you don't use it, then think about the opportunity cost of using other means in order to fund that expense. If you have some money set aside already for it, then maybe you don't have to go into your emergency funds. But if you see your bank account going to zero, then you shouldn't feel guilty or anxious about spending that money because it's serving the purpose. You created it for that purpose, and now your account is serving that purpose for you.
Okay, next question. There's quite a few about properties. I'll just combine them. So what's your advice for young people who just started working to start saving money, but also able to purchase a house? And is in the year 2023, is it a better idea to buy a landed property or to invest in buying a car for yourself?
Ooh, okay. I wouldn't call buying a car a form of investment because technically it's a liability, right? Like car values depreciate with time, but I don't see it as a wasted kind of expense because if your car is bringing you to a place of work and where you're making money, then perhaps it is a good way to spend your money. So that's on the car side. But I see cars and see houses differently because essentially, like I said, car is a liability, but houses are assets. Personally, I don't buy property. Even I actually even renting because I don't see personally the value of property and property investment. Property investment is a very complex form of investment. Doesn't necessarily mean that it's not suitable for you. But there's a lot of research that has to go into it because buying a house for yourself and buying a house for yourself to stay in and for investment is completely different. The criteria that you look at in order to buy a house for yourself is completely different from investing it. So we shouldn't think about buying a house for the purpose of both because they serve completely different purposes, right? If you want to buy yourself a house for your family to live in, then you can buy it for that purpose. There's no problem. But if you want to buy it for an investment, don't think that, oh, after a few years of staying in this rent, like this house, I want to rent it out. So that those are some things that you want to think about when you're buying property. Thank you, Calvin, for sharing. So if you want to look at property investment advice, there's this influencer called iHearn that you can follow. Personally, I like one called Marie Joel Condo, and I'll put that in the chat. Her name is Natasha. She's great in producing like property related content. She's not just, it's very different from like real estate agents telling you to buy houses because they use a lot of like scare tactics and different types of tactics to make you buy something. If you follow these kind of influencers, they are able to tell you how you should think about buying certain things. And in this, for this theme, it would be property investing. So I would recommend checking them out. They'll tell you when is a good time to buy, what kind of mindset you should have before you're buying property, and how should you choose property for rental versus property for your own stay, which is not for like getting more returns or like for a form of investment.
There's
Great.
also a lot of variables involved as well, right? Like if you have your own family, like what kind of house you'd be getting, and even what country you're gonna be getting the house from.
Exactly. So it's a lot to think
Mhm.
about. Yeah.
Okay, this is another psychology one. So, how do you build a healthy relationship with money after a lifetime in a scarcity mindset and being brought up with a scarcity mindset?
Yeah, I think that's really tough because, like if for 20 or 30 years or even 40 years of your life, you've been brought up to think about money negatively, it's not a 1 day or like 1 week or even a 1 year thing that you can do in order to change that. I think the first thing is probably to surround yourself with like the right type of content. So, for example, I think there are some recommendations of some great content creators in personal finance in Malaysia that was shared. One that was not shared was me, her Duit. So you may want to follow her Duit. I share a lot about money from a very positive perspective. I think when you start surrounding yourself or like you start consuming content that is more from like a abundance from a mindset when it comes to money, then you can slowly start changing how you view money. But the other tip that I've learned about how we shift how we think about certain things, like especially changing from negative to positive, is whenever you think negatively about something, take a pause and then try to switch that to something that's more positive. For example, um, oh man, like don't have enough money to buy for this. Instead of thinking about that, like take a pause because you already have the self awareness that you're thinking about that negatively. Switch, take a pause, and think, now I get to work towards buying this, or I get to have the opportunity to work towards achieving something that I want. So that is a way to think about it more positively. But it's a long journey. So hang in there, and you're not alone.
Yeah, it's progress. It's always going to be developing, isn't it?
Exactly.
And I guess it'd be a good idea to put maybe reward systems for like each milestone you reach as well.
Exactly. Yeah.
Um, I see we're approaching 12. The Q&A will still go on, but if some of you do have to go off, please do leave your feedback of this presentation. Tell us how you thought of Michelle.
Great.
Okay. Next question, another psychology one, I guess. How would you define financial freedom?
Oh, that is completely personal to
Mhm.
yourself. But for me, if you want to know what I think, financial freedom just means that I no longer have to depend on like a formal source of income in order to sustain my life. For example, we are all working now, and we are working because hopefully we love our jobs, we all love our jobs, but it's also a form of income, right, in order to sustain our lives. Because if we don't do this job, or do multiple jobs that we have, we can't technically survive. Financial freedom to me means that I don't have to pick to do something because I need to depend on it for survival. So I can still choose to work if I want to, but if I choose not to, it's not going to affect my daily livelihood. So that's what financial freedom is to me. And that's why I also, that ties into my question about buying a house. I do feel that when I'm tied down with certain types of debt, that I don't really feel that I can reach financial freedom. So that's also my personal reason towards why I can buy a house, but then I'm renting instead.
Yeah, it's not universal. It really depends on what your priorities are.
Exactly.
And you might not even reach that stage where you think you'll get financial freedom, but as long as you're progressing, it's
Exactly.
a good move. Okay, so we've gone through the registration questions. Let's do the live ones. This
Yes.
one's an interesting one. Do you know do you know about how our personalities may influence our views on money? The Myers-Briggs test with those types and how those different personalities earn the most or the least money.
Yeah, I've never really looked at the relationship between like the Myers-Briggs tests and our views on money, but I would definitely think that there is a relationship between that. But I think personality is one. I think maybe a lot of times our personality is also shaped by what I've mentioned earlier about how your money views are shaped, right? By your family, how you're brought up, certain characteristics and DNA about yourself, but also the media, the culture that we're in, and people around us. So I think personality is one component, but I think there are also a lot of other components that influence how we view money. So what that means here ultimately is try to identify what is the most influential for you. And if it's a negative influence, think about how you can break that influence. And there's no easy way around that. I think you just need to follow different people, listen to different opinions about things, read different books, watch videos, and then identify who resonates with you the most. And I think that's the most important when it comes to like finding the right fit for you when it comes to like listening to people talk about personal finance.
Agreed. There's another one. Feel so late to the financial literacy thing in my late 20s. Is there anywhere that teaches financial literacy to follow? Yes, it's on the screen right now.
Other than me, thanks, Irene. I think there are plenty in Malaysia. I think there was some sharing below of some personal finance content creators in Malaysia. So I think those are great places to get started, like Suraya from Ringgit or Ringgit, Mr. Stingy. I think that's Aaron who works at Luno, I think, and that Dividend Magic Lay. So they are all great influencers. But like I mentioned, I think everyone has their own take on what is most important to them. So, for example, like Dividend Magic focuses a lot on buying equities, right? And like growing your portfolio from that perspective. If you're not someone who resonates with buying stocks and equities, then identify another person or another creator that resonates more with what you want to do. Like you don't have to blindly follow what other people recommend, or you don't have to follow, like, we talked about property investment. You don't necessarily have to follow them, or you can follow them, try them out. If they're not suitable for you, you can unfollow, right? Find someone that resonates with you, that helps motivate you or give you the right not just not really advice, but like right kind of information that you want to consume. I think that's the most important when it comes to where you should get information from, because everyone's sharing all types of information today. So you have to identify what fits you the best and helps you work towards your own goals.
Right. And her do it is more woman orientated, correct?
Yes, more.
So how would that differ from just general advice? Like what kind
Yeah,
of differences does that involve?
that's a great question. So in in the realm of personal finance, men are typically more confident and more risk taking when it comes to investing and saving. Like, it is very similar to other parts of our lives when it comes to differences between genders, right? Male and female, for example, when men are applying for jobs, like they tend to, if they reach like 80% of like the requirements of a job description, they will apply. But for women, even if you can attain 100% of it, you still feel like you're not the right fit for the job, that you have imposter syndrome. So that's where like her Duit comes in. Like, I try to build confidence of women and show them examples of how you can use what you're good at in order to achieve your financial goals. So I show a lot of statistics around the world, and I use like I show them things that they want to read more about, and less so about like invest in ABC in order to reach your financial goals. I don't think women need so much advice on what to do. I think they just need to be given more confidence to do what they know like they can do.
Mhm. Okay. I'm going to combine these next two questions. So what's your opinion on purchasing an IPO, and what's your take on CP Capital?
I don't personally buy any IPO related stocks. I think there is one content creator that does. If you want to follow her, her name is called Nafisa, if I'm not wrong. But I do think it's something that's more like speculative, and it's something more active. And I don't really want to do any form of active investing. Like, I don't want to track like the company that's going on IPO, like start tapping at like 8 a.m. in the morning to buy a stock and then like quickly selling it when the price goes up before it goes down. Like, that's not my philosophy of investing. So personally, I don't. CF Capital, isn't that the Michelin star one? I don't think I know much about what they're doing yet, and other than bringing Michelin to Malaysia. So I guess I will watch and see what they're doing, but unlikely something that's related to like consumers, other than bringing the Michelin brand to Malaysia. That's the CF Capital that you're talking about, right? For the person who asked about CF
Yeah, I
Capital.
assume so. I'm not too
Right.
familiar with it either.
Oh, from Singapore, CP Capital, Asset Management. Let me see.
Right.
I don't really know about them. if you see that they are like approved by the regulators and seems like they're doing a good job, you can give them a go. But personally, I don't really invest through like fund management companies like this because the fees are very high. Yeah,
Mm. Okay. Just another psychology related one.
sure.
Um, hey, Michelle, just as you spoke about scarcity and the word budgeting, I'd love to hear your thoughts on the abundance mindset and the law of attraction.
I think it's completely related. Like anything that you learn about the law of attraction and the abundance mindset in other parts of your life is very similar to how you perceive money as well. So if it's something that you're familiar with, or if it's not something that you're familiar with, I'm sure you can Google what it's all about. But I think once you start thinking about money from a more positive way and thinking about how you can attract it instead of negatively thinking about it or repel it, I'm sure it can bring you a lot of abundance of money in your life. So yeah, I do think it's very closely related.
Okay. Related to the previous question that we asked about financial freedom, is investing the only way to financial freedom? As someone who hates math and numbers, struggling to find my way to all investing things.
That's a great question, Irene. And fortunately, but unfortunately, yes. I think investing is the only way to financial freedom, and that's because when we save and when we don't invest, which is like just keeping it in your bank account, with inflation, like your money will not work for you, and your money should be working for you. And the only way for your money to make you more money is through investing, because we don't want to always exchange our time for money. Like when we get to a certain age, when we are older, we want our money to be able to generate more money for us instead of like spending more time in order to make more income. So unfortunately, investing is the only way to achieve that. You don't have to actually like numbers and math to do investing. I think today there are a lot of different resources that are very accessible to people who just don't even really want to think about investing to start investing. So do follow or do it like follow the different content creators in Malaysia when it comes to personal finance, and I'm sure you'll find something that will fit um, your own personality and like give you the opportunity to invest without like having to approach things that you don't really like math and numbers. Yeah,
Okay.
no, you don't really look at stock graphs. I don't look at stock graphs myself.
Do we need this question was asked quite a lot during the actual presentation. Do we need to have a certain level of savings before we start investing? Because my savings don't seem to be enough.
Yeah,
And I guess related to it is when is the best time to start saving?
best time to start saving is probably a long time ago. Best time to start investing was yesterday. When how much you should have in your savings. Personally, I think is if I have my emergency fund sorted, then you can get started on investing already. There's an opportunity cost to saving too much. You can save too much money. I know your Asian mom may not agree, but you can save too much money because the opportunity cost of saving is investing. If you save too much and you don't invest, your money will only decrease in value with time, right? Look at the inflation numbers and look at how much your savings or your fixed deposits is bringing back to you, which means that even if how much you save, it will be less than what it is in 10 years or 20 years to come. So the only way to beat it is through investing, and the best way to do it is by starting as soon as possible. Even with 50 ringgit a month, you can already start investing. So I'm sure like a lot of us have the ability or like the cash to start investing today.
Okay, and last question. I don't want to hold you all from
Sure.
eating your lunch. Is it worth paying for a financial planner?
Oh, this is a polarizing question. I
Mm,
personally don't use a financial planner because I think there are a lot of things that you learn through doing it yourself. What I read about a year or two ago is that when you hire a financial planner, no problems, like not dissing like financial planners, but you're technically outsourcing your learning. And I think money is a lifelong thing. Like you will always be using money, you will always be thinking about money, and you need money to survive your entire life. So I do think it's a topic or component of your life that's worth learning more about. And the only way to do that is to go through that journey. Not yourself, but like go through that journey without having to hire a professional someone. But I don't think there is anything wrong with hiring a financial planner. I think even with a financial planner, like do still take interest in, learning more about personal finance yourself. Like be curious, like ask questions. I think there are many good financial planners in Malaysia. But don't just like outsource it completely to them and like say I don't want to know anything. Like just you handle all my money for me. That's how I look at financial planning.
Okay, thank you very much, Michelle, for answering these questions.
Great.
I do see there are quite a few more questions. Do remember you can reach out to your Naluri coach or give Michelle a follow on Instagram, and the link's on her link tree if you want to message her directly. Is there anything else you want to cover up just before we wrap up, Michelle?
No, I just posted. So if there are any questions that are burning and you would really like to ask me, you can also drop me a DM on Instagram and hopefully I can get to them and answer you personally there.
Okay. Just gonna close this. Okay, so great. Thank you, everyone. Really appreciate you being here.
Thank you.
Before we sign off, I'd like to remind all of you to give us feedback on the presentation. Feel free to fill up the survey form from the pop-up I shared earlier, and be sure to visit her Duit on Instagram, and as well as the Naluri community site if you're interested and want to know more about future webinars. Share it with your friends and family. We'd love to see more faces next time. Thank you again for joining us today, and we'll see you at the next webinar. Goodbye.
Bye bye.